When considering portfolio management styles, investors are typically faced between choosing an active or passive approach. This is based on their long-term financial goals as well as their willingness to take on risk exposure. An active approach, as the name suggests, requires a significantly higher degree of monitoring and attention. Active investing focuses on trying to outperform the market's average returns by taking advantage of the short-term price movements of stocks and trading in and out of positions on each trade. The active approach is riskier since it is tempting to time the market and profit off swings in price levels. However, with more risk comes a potential for higher returns. A successful active investing strategy requires an investor to take on the role of a portfolio manager to constantly monitor the markets for news and events that may present a new opportunity or risk to the current portfolio. A passive approach is driven by a long-term focus in contrast to the active approach. Passive investing requires less maintenance and is relatively stable in the long run. Here, investors are focused on the long-term appreciation of the market price levels. Investors hold their positions for a longer period since equities tend to rise in value over the long run. The advantage of the passive approach is that it allows investors to not constantly stress about the short-term market movements. It is more cost-effective since they can avoid the heavy transaction fees from frequent changes. It is common practice for investors to use both of these approaches. Keep in mind that an investor doesn't necessarily have to choose one over the other. Applying a blended strategy of both active and passive investing allows you to get the best of both worlds through a diversified approach.